I want to walk you through how the math actually works between a 15-year and a 30-year mortgage, why most borrowers should take the 30-year, and the specific situations where the 15-year is actually the better call. The basic difference between the 30-year and a 15-year mortgage is the amortization period. A 30-year loan stretches your payments over 30 years, while a 15-year loan compresses them into 15. Same loan amount, same property, but the monthly payment on a 15-year is significantly higher because you're paying it off in half the time. The interest rate on a 15-year is usually a quarter to half a point lower than 30-year. That's why people do it, because you can always pay off a 30-year mortgage in 15 years, but you might consider a 15-year because you'll get the lower interest rate. So you save on the rate and you save on the total interest paid because you're paying interest for fewer years. Those two savings together make that 15 years sound so attractive in the abstract. Here's the math on a $400,000 loan as an example. You get a $400,000 loan over 30 years at a rate of 7%. Your principal and interest payment is around $26.60 per month. And at a 15-year at a rate of 6.5%, that same $400,000 loan jumps up to around $34.85 per month, about $825 more. The total interest paid on the 30-year is about $550,000, though, over the life of the loan, while over the 15-year loan, you're only paying $227,000 in interest. So the 15-year saves you around $330,000 in interest, and that's the number the 15-year advocates would want to lead with, right? It's a real number. But here's what a lot of people miss is that $825 monthly difference is locked in for 15 years. Okay. It's a forced savings plan. You can't invest it in something else. You can't redirect it if you have a bad year or if you start a business or if your roof needs replacing. You're going to make that additional $825 monthly payment no matter what. Okay. It's a forced savings plan with no flexibility. The 30-year mortgage has a little bit higher rate, but it gives you the flexibility back. You can apply the $825 to the mortgage every month if you want, but then if you would rather invest it in something else or open a business or do some repairs or whatever you need to do, you can keep it in cash for emergencies and only deploy it when life is stable. You have flexibility with the 30-year. So the 30-year with extra principal payments gets you that flexibility while keeping the option open to pay off the loan in 15 years. And that opportunity has value, especially if you're self-employed, if you're a family with variable income, or really anyone whose financial picture might change. The 15-year becomes the better idea when you have stable, high income compared to your expenses. You've already maxed out your retirement accounts and your emergency fund. You're disciplined, and you wouldn't invest the difference. That $825, you're going to make that extra payment no matter what. And you have a value of being mortgage free in 15 years or less, and you're serious about that. And that's not going to change. In that case, it's worth taking the 15-year. You'll get the lower rate and pay even less interest over that 15 years that it takes you to pay off the mortgage. So the locked-in savings of a 15-year are not worth the optionality for most buyers, but for some folks in the right situation, it can be even more savings when you're already going to be advancing your payoff. So if you want to run scenarios and look at specific numbers, schedule a discovery call, and I'll show you the math side by side.